This is Tax Chats. Hello, I'm Scott Asay.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello and welcome again to another edition of Tax Chats. I'm Scott Asay, professor of accounting at Duke University, and I am joined, as always, by Jeff Hoops over at the rival school, UNC. Hello, Jeff.
Hello. How are you doing?
I'm doing good.
You look good today. You look especially good, actually.
Well, thank you.
Better than usual.
Too. You always look good. I don't know if you look better than usual, but you look good.
Well, so what's important is we have no guest today. It's just us. So that means our pictures are bigger. So you can see more of me.
That's right. And that's, of course, only true if you're watching on YouTube. If you're listening, you are suffering possibly because you have to listen to Jeff and I the entire time as opposed to some smart guests that we often have involved. And I'm particularly happy because Duke and UNC played basketball recently, and it was quite an interesting game. If you like Duke, if you don't like Duke, it was pretty painful.
It was a little bit painful. I walked into class on Monday morning, and my students looked like it was like the worst thing ever. And I actually asked, I said, when you buy all this alcohol to celebrate the win, what do you do with it when you lose? And they said, we drink it anyways. And it looked like they had drunk it.
They drink in their misery as opposed to their celebration.
Yes.
Yeah. I'm not surprised that you had a sort of sulky mood on Monday. It was not so great for you. It was good over here at Duke. Students were happy. Well, today Jeff and I want to talk about costs of tax avoidance. So Jeff and I have spent a lot of our careers thinking about corporate tax avoidance and how that works. And so let me just maybe give a very brief overview or some background that might be useful. When we talk about tax avoidance in the academic literature, what we typically mean is your effective tax rate relatively low? And an effective tax rate is simply this: how much tax did you pay divided by how much income did you report to your shareholders? So the ratio of how much tax you pay to how much income you report to your shareholders is an effective tax rate. And if that tax rate is low, then we sometimes say the firm avoided tax. But it turns out that ratio...
I want to add in, and we say that, and we want to call it, we want to connect those two things just because that makes tax avoidance really measurable. We're going to actually define tax avoidance by something we can directly measure, as opposed to like some firm intent or something else. So we've defined it by something we can directly measure. Which is pretty important, actually.
That's right. We can see an effective tax rate.
It's very important. It's also like a little bit tricky. It's a
little bit like cheating because we're not going to. But in any case, that's become the standard, at least to some extent, in the academic literature. One of the problems with that is, as you point out, tax avoidance, defined as I just mentioned it, can arise for many reasons. Some might be because the company is sort of strategically arranging its, business endeavors to pay low tax. And in other situations, it might happen just because the law was written in such a way that the company didn't have to pay very much tax relative to its income. And that's kind of more of almost like a benign or an unintentional or an incidental type of tax avoidance, as opposed to something that's like very intentional or thought out or strategic. So when we talk about tax avoidance, we're talking about all types. And what we're going to talk about today, I think it doesn't actually matter if it's intentional or if it's strategic or whether maybe it's incidental and benign, because we're going to talk about how people perceive tax avoidance outside of the company. So when we think about tax avoidance in general, we think, the benefit of avoiding tax if you're a company is that you pay less to the government and that increases your net income. If you increase your net income, your shareholders might be happy about that. And so there's a big benefit. But these really famous guys, Myron Scholes and Mark Wolfson, who were at Stanford, in like the 80s, they came up with this framework. And the framework said, whenever you think about taxes, and tax planning, you should think about three things. You should think about all of the taxes that you pay. You should think about all of the parties involved in a transaction and the taxes that they might pay. And you should think about all of the costs involved in your tax planning or your tax avoidance. And today we want to talk about some of the costs of tax avoidance. And in particular, we're going to talk about what do individuals, consumers, for example, think about tax avoidance.
Yeah.
Have I missed anything in our background, Jeff?
No, there's a lot of these different costs. And on some of these costs, there's like a huge literature, especially in accounting, on some of these costs. So for example, there's financial accounting costs to tax avoidance. You might pay less in taxes, but you might report lower earnings to shareholders and they get upset. There's enforcement-related costs. You avoid taxes in some way that's illegal. The IRS is not going to be happy. That's actually a costly process to sort that out. You might end up paying some of those taxes back. So there's all these different costs. And then one of the buckets is reputational-related costs. And we say that. And within reputational-related costs, there could be politicians get upset with you and they pass different laws because you affected your reputation. It might be that shareholders, you said shareholders are just out to get money. Might be some shareholders actually do get some consumption value out of just like holding a company that they think is doing the right thing, and shareholders might get upset if you're avoiding taxes. But within that bucket of reputational costs, it's exactly what you said, consumers. So we want to know, is there a cost to consumers being irritated by companies not paying what they perceive is enough taxes? Okay,
and so you said something important, what they perceive as, because
exactly
what exactly right. is like the fair share of taxes? It's not entirely obvious, but it does seem like if a company has a very low effective tax rate, then there will be like a article in the Wall Street Journal or the New York Times and a bunch of tweets on Twitter that say this company is not paying its fair share. And if that happens, one question might be, do consumers care? Yep. So sometimes we see little examples that might suggest that they do care. And maybe we should start off with maybe the most famous example, which is Starbucks. Do you think that's the most famous example, Jeff?
I would say that is the most famous example.
Okay, so I'm going to tell the story and you fill in the gaps. So this was maybe 10 years ago. Starbucks reported in England that it had paid no tax, but it reported that its sales had grown dramatically. And this led to protests in England outside Starbucks stores. People were literally walking around with signs outside Starbucks stores that said, pay your fair share, and, decrying the evil tax avoidance of Starbucks, the highly profitable coffee company. And the idea would be, well, if people are protesting outside your store, maybe nobody will go buy coffee from Starbucks anymore.
And some people were saying they weren't buying coffee, right? There was this idea, this notion that there's like this massive boycott.
In fact, it's very easy to go on like YouTube and Google Starbucks tax avoidance, and you'll find like these news clips from England where the newspaper reporters are interviewing Starbucks customers, and they're saying, yeah, I'm mad at Starbucks. I'm not going to buy any coffee.
Yeah. So what our paper basically does is kind of uses that, as it uses that as a motivation. It says, look, when we say, do consumers get upset about tax planning or tax avoidance, whatever you want to call it, do they actually buy less stuff? And if you say, well, for sure we know that happened at Starbucks. Well, we actually do this later on in our paper, but I want to start there. I don't think we actually know that they actually did that with Starbucks.
Well, so hang on. Let's back up even further.
Yep.
We didn't even tell people Jeff has written a paper with some
co
co-authors, and it's called Tax Boycotts. And we're going to talk about that paper. And I think the Starbucks thing sets the stage. But what Jeff is saying is, in an academic paper, you can't just say, oh, we read on the news that people boycotted Starbucks. You actually have to go use real data to check to see if there was any boycotting happening. So what did you guys find out?
Yeah, so this is a paper, again, Tax Boycotts. This is a joint work with Scott Asay, who's at the University of Iowa, Jake Thornock, who's at BYU, and Jaron Wilde, who's also at the University of Iowa. And so again, you look at the Starbucks case, if you talk to anybody about tax boycotts, they say, oh, Starbucks, there's a tax boycott. I think the way you told the story just needs a little bit of addition, right? It's not that there were these massive protests, it's that we saw these on the media. It was the perception of these massive, from this side of the pond, it was the perception of these massive protests. And then,
but they were actually protesting.
There were some protests, right? So this reminds me actually, like, at a lot of universities, we have students that get upset. So, for example, where Scott and I both graduated, every once in a while, students will get upset about something, and you'll see on the news like these protests, and they'll cover, and you'll see these students with signs. But when you were actually on campus, you watch the media, and there's students and signs. But if you're there in real life, it's like not that many students and not that many signs. It just looks way bigger on the media than it does in real life. So what we do in the paper, just to look at the Starbucks example, is basically look at any public data that we can on Starbucks and see in this time period where the media is reporting on all these protests and all these boycotts, can we actually see any change in anything related to something in Starbucks? And the problem is, like, the data is not that great, but any data we look, we basically can't find any effect. So for example, Starbucks reports on the number of stores they have and the stores they open, the stores they close. And so you can look at net store openings by country. And we basically see no change in net store openings in the UK compared to Taiwan or Japan or the US or South Korea or any of the other stores they open. They report on quarterly worldwide sales. You don't see any dip. It would be surprising if there was a dip because Starbucks operates a lot of different places in the world. We don't see any change in annual sales by geographic segment. So you can say, well, they operate a lot of different places in the world, but we can separate US because they have a US segment and they have an other countries segment. We don't see any change in other countries segment. But then most importantly, you don't see any change in their revenue per store for Starbucks Coffee Company UK Limited, which is one of their UK subsidiaries. So basically, any data series you find, you can't actually see a drop because of this thing that was widely reported in the media.
So there might have been a couple people who said, I'm not going to go buy my coffee at Starbucks, but it was so few people that it did not put a detectable signal in any of their financial results or in any of their economic activities like opening new stores or anything like that. You can't see it in the data. Is that correct?
See it in the data we have access to. And what I think is important is, as we said, like if you see in the media, that the perception looking at the media that this was the thing, that's not just a perception when Scott Dying or Jeff Hoobs read the media. I think that's also a perception when tax directors, Big Four tax partners, people who are actually involved in these decision makers are reading the media as well. So I think actually
that's important because I think we know that the Starbucks people cared a lot. Because if I remember right, didn't they actually make a voluntary tax payment?
Well, so that's interesting, right? If the argument goes like this, is there tax boycotts? And somebody on the other side says, oh, of course, Starbucks. And I say, well, like they didn't actually sell that much less stuff. The person on the other side will say, but Starbucks was really worried about it because they paid a whole bunch of taxes. They paid something like 20 million pounds in voluntary taxes. Which, I mean, I would be happy if somebody gave me 20 million pounds. But for Starbucks UK, it's just not very much money. If you measure the costliness of something by the action that somebody is willing to take to avoid it, that wasn't that costly to Starbucks UK.
But it was a voluntary tax payment, right? They didn't have to make it. They just said, we'll pay $20 million to make this thing go away. 20 million pounds.
20 million pounds. It's just not that much money, actually, though.
Yeah.
But of course, to consumers, it sounds like a lot of money, and so they kind of settled down. It went away. Maybe they just forgot about it. Actually, in reality, it's probably not that many consumers that were worried about it, but the media stopped covering it as much after these payments. So again, back to what I was saying is like the perception that these things exist isn't just among some academics, but it also exists among tax directors themselves. And so when you ask about tax reputation related costs, there's kind of two things. It's one, is there the perception that these exist among the decision makers at firms? And number two, is there actually evidence that they exist? And that first
let's talk first about whether managers perceive there's a cost.
Yeah,
tell us what you know about that.
I think there's some pretty good evidence that there is, actually. So John Graham, Terry Shevlin, Nemeth Shroff, and
Michelle Hanlon. I didn't do that in order. Sorry, guys. Typically in accounting, we do everything in alphabetical order by last name, and Jeff just goofed, but that's okay. It's no big deal.
Sorry, they'll forgive me, maybe. In any event, so they have this paper. It's a really neat paper where they basically just ask managers, like, what are you worried about? So the question is like, what are you worried about? Why don't you do more tax planning? There's clearly things you could do to pay less in taxes. What is it that keeps you from paying less in taxes? And some of the biggest reasons are just broadly reputational related costs. And I'm worried about being on the front page of the Wall Street Journal or the New York Times. And so when you ask them, they're worried about this because it's not surprising at all, right? They see the newspaper, they see all these protesters outside of Starbucks. They don't get a chance to look at Starbucks sales. They just assume it must be having some kind of effect. A. B. They also think about taxes all day, every day. And even though they think about taxes 100% of the time, they assume everybody else probably thinks about taxes, maybe at least 0.5% of the time, 1% of the time. When in reality,
they think about it enough to matter, at least. That's what they perceive.
Yeah. But in reality, if most normal people in the real world think about corporate taxes 0% of the time.
Or when they read the headline in the Wall Street Journal, but that's it.
If they read the headline in the Wall Street Journal. So now getting to our paper. So this is actually super important. So when they read
hang on, I want to back up just a little bit.
Yep.
I think that you and I have a quote in one of our papers that we wrote, I think, if I remember correctly. It's in a paper that someone wrote. And it's a quote from one of the directors of the Big Four talking about tax risks. And the quote goes something like, and I'm going to paraphrase, but it's something like, the public often holds companies to a higher standard than the auditing tax authorities do. And that's the perception of the cost, that the public standard is like tighter than the actual auditor because the public doesn't care what the law says. The public cares about the did you pay a quote unquote fair share? And if it looks like it's too low, then the manager is going to look bad and then that's costly. At least the manager thinks it's costly. Am I remembering that correctly?
That's exactly right. So that's in a report by EY in 2014. And you got it exactly right. It's because the public doesn't care about what's legal, illegal. They just read a news headline, the perception is that they read a news headline and that they might get upset. So then the question is, why do I keep on focusing on there's a perception? So let's get to what we actually do in our paper, the paper Tax Boycotts. So, let's just talk about what I just said. So do people actually read the news about taxes? So we did a survey. We asked 500 people, all sorts of different questions. We'll get to all the other questions. But one of the questions is like...
Hang on. Who are these people?
So these are representative consumers in the United States. So representative along like income. I can't remember all the different parameters, but we try to make them
it's not
We're not asking our students. We're not asking our undergraduate students. We're not asking MBA students. We're not asking professors, heaven forbid, who cares.
It's like you went down to Albertson's grocery store and surveyed a consumer. That's not literally what you did, but it's that type of person.
Where's the nearest Albertsons grocery store, Scott?
I don't know. Out here we have Harris Teeter, not Albertsons.
We have a Walmart where I live. What are you talking about?
Food Lion, Walmart, Albertsons.
Walmart. We're Walmart people in Pittsburgh.
Yeah.
Okay, so what is it? I guess so. This is just like a just representative sample of consumers. Okay, so when you just ask them, have you ever read a tax-related story in a newspaper? The vast majority of people say no. I can't remember having ever read one. That's actually pretty important, right? So it all starts as we're worried about being in the front page of the Wall Street Journal. Well, most normal people on earth who actually buy products from these large consumer-facing companies don't read the Wall Street Journal. A. B. If they were to read the Wall Street Journal, they're not going to get to the business section. And if they get to the business section, they won't read the story about an ETR because they literally don't even know what ETR stands for and don't care about it, even if they did know what it stood for. They just don't think about taxes. Effective tax rate.
Effective tax rate. So that little chain of logic does not send a positive signal to me about the future of tax chats as a mass market appeal podcast. Oh, well.
We're going to change that. Everybody's going to care about taxes. Yeah.
Yeah, anyway, but I think that's a really important point. The typical person just doesn't care. They don't think about that. It's not what they're thinking about. They're thinking about other things.
Got a lot of other stuff to think about that's way more important about some company not paying what some journalist perceives as a fair share. Okay, so we asked that. So what other questions do we ask these consumers? To me, the two most important questions that we ask is we ask, have you ever boycotted a company? And if so, for what? Now, importantly, we don't say, have you boycotted because of taxes? We just don't want to like spur in their minds anything about taxes. We just say like a complete free, it's just like fill in the blank. We don't give them check boxes. Just say, tell us why you have, for some principled reason, not bought the product of a company. And out of the 500, guess how many boycotted because of taxes?
I can't guess because I know. So should I reveal the answer, or do
you
you
reveal
want
the
to?
answer? You reveal the answer.
I thought I read in the paper 0 out of 500 said they had boycotted for tax purposes.
0. We're actually in the referee process, and for a variety of reasons, we actually redid the survey. So we did it once. It was 0. We were really scared if we ask another 500 people, maybe like 1 would be it, and we wouldn't get as scandalous an answer. In the second set of 500 people, also exactly 0 said anything about taxes. It's just not a
But so here's
thing.
a question: like, how many people boycott companies for any reason? Are there some?
Some.
Did everybody say we don't boycott for anything?
There are some, and that's actually important kind of as we're revising the paper. That's something we do is we basically have this data. We'll talk about it in a little bit. And we can show that some people do get upset about some things that companies do. It's not that you don't care about corporations at all. It's just taxes aren't the most important thing at all.
Can you give me an example of like one thing that people do
like
get upset about?
Environmental concerns, labor things. I mean,
so if I'm known to be dumping sewage
waste,
into
they probably care about that maybe a little bit more than taxes. But when I say a little bit more, I should have these numbers memorized. That's actually in the paper as a specific thing, or it has been in some version of the paper. So another, one thing we ask in one of the versions of this survey, I'm not even sure if it's in the current version of the paper, is you just ask like, so what is important when you buy a product? Well, turns out price, quality, the perception of value, like there's a long list of things, and basically dead last when we do mention taxes, dead last is like, oh, how much taxes the company pay? People just don't think about it. Okay, so we ask number 1, why have you ever boycotted if you boycotted? The second question is, can you like list the things you could imagine boycotting over? So you don't have to have done this, but you could imagine doing it. It's possible.
So if I, for example, read something about a company not paying, can I imagine myself boycotting because they didn't pay enough tax?
And you do get a couple, but just not that many people at all saying they could imagine some hypothetical world in some far distant planet that like they might be able to imagine boycotting because of taxes. But again, nobody ever did it. Okay, so we did a lot more stuff with the survey.
Let's just talk. Let's let that sink in just a little bit. That, to me, is sort of an amazing finding, because if you live in the world that you and I do, where we're surrounded by taxes and thinking about taxes and teaching about taxes and researching about taxes and talking to tax directors, it's easy to believe that the typical consumer is going to say, oh my goodness, I just heard that Amazon earned $11 billion and didn't pay any tax, so I'm not going to shop on Amazon anymore. I'm going to go to eBay or something like that.
When that Wall Street Journal article comes out, or that New York Times article comes about, you and I are going to talk about it. We're going to want to do a podcast about it. When we go to something with like tax directors or Big Four partners, they'll be talking about it. The people at these think tanks are going to be talking about that article. But it turns out, you know who's not talking about it?
My mom.
Your mom. My mom, my dad, all the people who shop at Walmart or Albertsons, whatever on earth Albertsons is. So they just don't care. Okay. So to be clear, like, why do we think they might care? Well, the academic literature has a pretty good precedent for them caring. Like a lot of these prior papers that look at related issues look at like, is there a stock market reaction for companies around negative tax news? And they'll say, is it bigger for consumer facing companies? Is it bigger for retail companies? Is it bigger for companies that should care about the customers? So there is a pretty strong precedent for thinking they might care. But
the research papers, not only do they ask that question, they actually find evidence.
They find some evidence. And
some evidence.
Where that evidence comes from. But yeah, so this isn't we're just like made up the consumers might care. It's that there's an academic precedence for thinking they might care, but when you just ask consumers, they don't care. Okay, so again, we do a lot of stuff in this paper. We need to move to so we can talk about something else we actually do in the paper. So one of the other things we do in the paper is there's this company, Nielsen, that has access to what we call the Nielsen scanner data. So a whole bunch of different stores across the whole country that give basically data on what people buy to Nielsen, and you can get that data from Nielsen. There's all these different checks so that you can't like do anything nefarious with the data, but it basically allows us to see on a weekly level how many people buy a very like a product, and it's like is it
called the scanner data because they're basically pulling the data out of the cash register from when the clerk scans every single thing that you buy. Is that what's happening?
I believe that's the case. Yep.
Yeah. Okay.
And so it's not just like it's not like you know how much was purchased from some specific store in some specific city. It's you know how much of a specific brand, like a 12-ounce can of some specific product. You know, it's exactly that product.
Is it Coca-Cola? Is it Pepsi? It's not just, is it a soda?
You know, and is it cherry or is it grape? And is it a 12-ounce can or is it a 2-liter bottle? You know exactly the UPC.
And that's going to be important because if Coca-Cola is in the headlines for avoiding tax, but Pepsi isn't, you might want to be able to distinguish between a Coke and a Pepsi.
Yeah, and so that's exactly what we do, actually. So we basically go to the media, we find all the times where you get negative tax articles about companies. And one actually important thing from that is just the data collection process. We go out and find all these. There's not actually all that many. So we have this perception that like if you have a low tax rate, you're going to get covered in the news. There's not actually all that many news articles about these things. So when they happen, like they shake our lives when we talk about them. But if we actually go out and like write a big list of them, there's just not that many of them. So
they shake my life and your life, but they remember, don't shake the lives of our parents.
Don't shake my mom's life. She doesn't care at all. Okay? Yeah. So, and she's the one, she and all of her people are the one actually buying stuff in this country. It turns out the Jeffs and Scotts of the world don't buy that much stuff because there's not very many of us. Okay. Yeah. So we basically look to see after these few negative tax news events, do you see any change at the weekly level of purchases of products for these companies? You don't see it. Like, and you can slice and dice the data pretty much any way you want. You just don't see any negative reaction as far as consumer purchases. And so, you know, you worry about maybe on the survey, they just like forgot if they did this, but it's pretty consistent with the survey. It's just like a flat line. You graph it out, it's a flat line.
So to give a purely hypothetical example, suppose that Coca-Cola hit the Wall Street Journal today for having a really low tax rate. That didn't happen, but just suppose it were to happen. Your scanner data would say, okay, for the next week, starting like tomorrow, let's see if Coca-Cola sales drop relative to, say, Pepsi sales and relative to what they were the week before. And you find nothing.
We find nothing. And it's not just Coca-Cola sales, but it's, well, maybe Coca-Cola has lots of different brands and only some of the brands have Coca-Cola in its name. We look at that, only the ones that actually say Coca-Cola in the brand, because maybe people don't understand that Coca-Cola Corporation has a lot of different products, that some not all of which actually have the brand Coca-Cola in its name. So like anything we do, we just like can't find a result, which is actually pretty interesting. I mean, in most papers, you go out, you find a result, and you try to do every single test possible that also finds results. In this paper, we don't find a result, and then every possible test we can think of, we also don't find a result.
You just can't find anything anywhere.
It's just not there, right?
Okay,
and again, could you just go back to like, does my mom, saintly as she is, care about this at all? No. Neither does my wife. Neither does anybody. Any normal person just doesn't care about this that much.
So let's tie this back to some of the academic literature that does find effects. You and I have written a paper, and in the paper, this is co-authored with Jaron Wilde, and in that paper, we found that firms that were kind of, I guess they were sort of like called out by an NGO in the UK, these were British firms, then that caused these firms to sort of change the location of some of their subsidiaries away from tax havens. And we would say, well, that sort of conflicts, but
and to pay a little bit more in taxes.
And they pay a little bit more in tax. And I said earlier, that's sort of weird. And you said, well, it's not really a conflict. And you explained to me why you didn't think it was a conflict, and tell me why.
So that's not a conflict at all, because in that case, it's not consumers that are driving this. So the person who makes the subsidiary location decision or the tax avoidance decision is the tax director. And we know that the tax director perceives this cost. I'll get it right this right. Graham, Hanlon, Shevlin, Schroff, is that in alphabetical order?
I think you're good, yeah.
Okay. They asked the tax directors, and they're like, do you think this is a problem? And they think it's a problem. So there's perceived cost, but there's not an actual cost.
Okay, so that's sort of that's why the perceived word is really important here, because managers might take actions based on things they perceive, even if those things don't bear out in the data. I think it's also worth talking about it. The market participants might perceive a cost, and we mentioned this briefly, but Michelle Hanlon and Joel Slemrod wrote a paper. It's been quite a number of years ago, and in that paper they said, when these headlines appear, does the stock price of the companies drop? And the answer was yes, but there was a giant caveat. It wasn't very big, and the price seemed to recover after a relatively short amount of time. And then there was a follow-up study.
So the follow-up study is the one that finds the price seems to recover. And when you say it's not very big, actually, if you look at the table, there's a lot of their tests in which it's not a significant price drop. So we always say the price drops in the Hanlon-Slemrod paper.
Yeah.
It's just not a very strong result, and they completely acknowledge that.
Yeah.
And then in again, I gotta like get my alphabetization right. Gallimore, Maydew, Thornock. It's also not just the alphabetization, but of course I'm seeing these people's faces and I think of them by their first name. So you have to remember
we don't ever say Gallimore, Maydew, Thornock. We always say
like Ed
John,
Maydew is literally
Ed,
like
and Jake.
behind me in that wall. And so I have to, what is Ed's last name again? Anyways, so Gallimore, Maydew, Thornock find that like these prices, even if they go down, which it's not by a lot, they come back up. And so like it again, it's all perceptions, right? So you might, as an investor, see this in the Wall Street Journal. You might get a little scared. Oh, maybe consumers are going to buy less stuff. Or maybe it's one of these other reputation related costs. But over the long term, the price doesn't go down.
So you guys kind of built on that then in the Tax Boycotts paper by looking at a certain type of investors. Tell me about that.
Yeah, so we found access to, there's this data set called the Robintrack data. So it used to be the case that Robinhood would give you on a daily level basis how many Robinhood users owned each stock.
And for those who don't know what Robinhood is basically a trading platform that is characterized by lots of small individual investors using it. Is that accurate?
Yeah, mostly on their phones. They're younger. They're not as wealthy. They have less experience. It's like a super retail investor, right? And so Robinhood used to release this data, how many Robinhood users own each stock every day. So you don't know how much they own. You don't know anything other than just like the number of users. But what we look at is for the same kind of negative tax news event days, the number of Robinhood users for those stocks that had the negative, for the companies whose stock had these negative event days, doesn't change. So these retail investors at least don't seem to change their holdings enough to show up in the Robintrack data.
So it's possible that each user sells some, but they don't abandon their positions altogether. Otherwise, you would see the number of investors dropping.
Correct. And it could be that there's like some people who hate tax avoidance, some people who love tax avoidance, and they just like sell amongst each other. We wouldn't also pick that up.
Yeah.
But it's basically a flat line. I mean, the paper is basically just like a series of flat lines. That's how we should summarize.
Everything you try, there's just nothing there. So the takeaway then is nobody's really boycotting for tax reasons.
At least it's really hard to find evidence that they're boycotting for tax reasons. That's exactly right.
So give me like if you were, let's play hypothetical here. Jeff's gonna not like this, but I don't care. Let's suppose the tax director for a Fortune 500 firm walked into your office right now and said, our effective tax rate is going to be low this quarter or this year, make it a year. What should we do? Should we change things around? Should we engage in some efforts to counteract the negative media that's going to inevitably occur if the Wall Street Journal publishes an article about this? What should we do? Would you give any advice?
I would not worry that much about it. I mean, people, if the Wall Street Journal decides to cover you,
which is a big if.
Which is a big if. I mean, Scott and I could put together a list of companies that have low effective tax rates. It's not very many of them at all that show up in the Wall Street Journal.
The list of companies with low effective tax rates is fairly big, but the list of companies with low effective tax rates that get covered by a major media outlet, that's going to be really small.
It's quite small. So if you get covered, how many people will read it? if they read it, how many people will remember it next time they're going to buy something? And if they remember it, how many people care? And I think at some point the answer is pretty much less than you care about, like fewer people than you should be worried about. So what's the kind of practical implication of this paper? It's like, if you're doing things in the tax world because of these consumer-related reputational risks, and again, the consumer part is important. If it's consumers that you're worried about, you should probably not worry about them so much.
But if you're worried about politicians who might read this article and then change the law that makes it less favorable for your company, then that's maybe a more significant concern.
Yep. That's certainly
I say maybe. We don't really have a lot of evidence. We don't know,
and I've thought quite a bit how to try to test that. But if it's it's really hard actually to get all this consumer data, and that's why we had to go to so many different places because it's hard to get data on consumer activity, at least in this situation. You got a lot of consumers. There's not very many politicians, and knowing what they think or what they're doing or how they feel about this is pretty difficult.
Very difficult. Well, it's very fun to talk about your research, Jeff, and I really think the paper is quite fascinating. So it was fun to take a look at it. And we look forward to having more conversations like this in the future. It's always fun to chat about what we love and we hold near and dear, even though our mothers may not appreciate the nuances of what we're doing.
Yeah. But they'll come around someday.
We're working on it.
Yeah.
Thanks again for joining us on Tax Chats. I'm Scott Dyring. We'll talk to you next time. Goodbye.
Goodbye.